BMO Capital Markets Chief Investment Strategist Brian Belski has a target of 5,100. Joins us this morning. Brian, it's good to see you. You say don't mistake our indifference on market direction as a recommendation to avoid exposure to U.S. stocks, right?
No, we don't. Thank you so much for having us. We're really worried about the Johnny-come-lately bulls. We've been saying that we're in a 25-year secular bull market since 2010. In this new part of the bull, the cyclical bull market, started in October of 2022. We said that in November of 2022. Now it seems everyone's saying now what we said 16 months ago. From a sentiment perspective, that has us excessively worried. I'll remind everyone that our bull case that we published on November of this past year, 2023, was for 5,500. So it's not that we're bearish. We just think on a near-term basis that the market is ahead of itself, that everyone's kind of chasing the same stocks. And this herd mentality traditionally is not a good time to be buying stocks and adding to positions, but we're still bullish longer term.
You also point out you think the market's placing too much emphasis on the timing and the magnitude of Fed cuts. When does that end?
Well, too many people have been watching Fed funds futures, which, oh, by the way, have been wrong for a year and a half. And I think the predominant theme of the Fed in watching and doing whatever the Fed says has really been in place now for all intents and purposes, Carl, since August of 2007. And when we were down to zero interest rates, that's not normal. I think what is going to happen over the next several years is we return to this normalcy of a 3 to 5% 10-year Treasury. Every time the 10-year ticks noticeably above 4%, the market sells off. And we think that there's some risk that the Fed does not do anything. And, oh, by the way, that's not risk. That's actually okay. We actually said this in our report, too, in November, saying, wouldn't it be cool if the Fed doesn't do anything? And what if the Fed does nothing? And I think that there's a very good chance the Fed stays pat all year long, and I think that could surprise a lot of investors.
You're already at 250 for 24 EPS. Any chance that goes higher?
Yes. In fact, we think, and we, as you probably remember, we've been pretty bullish on financials, especially the money center banks, the asset managers, and the broker-dealers. And we think those earnings in particular are way too understated. I think that's where we're going to get the big lift-off, as well as some of the tech earnings that I think are going to surprise. Remember, seasonally, the tech stocks do very well the second half of the year in terms of their earnings. So I think we're going to see continued earnings surprise there. So our 260 number, which is our bull case, I think is quite attainable by year end.
Finally, at what point does election risk or election volatility risk begin to creep in? Is that a summertime story or later, sooner?
I think we give politicians way too much credit. We've written a lot about how politics have nothing to do with the absolute performance of the stock markets, what's happening in the economy, in the stocks in general. Like, just look at 2020, Carl, into 2021. The reason why the stock market went up in 2021 is because of 0% interest rates. Nothing to do with the fear of the blue wave and all of that, which everyone was worried about. And I think that's the best near-term example that, again, we give politicians way too much credit. However, I will say, there could be some volatility come around convention season, which is obviously in July, so hang on to your seat.